Investing is the best way to build wealth and achieve financial independence, but unfortunately, the vast majority of individuals end up losing money when they try to invest due to uninformed decisions that they might make. The road to achieving financial independence may be paved with a number of financial blunders, the avoidance of which would have accelerated the pace at which one might achieve their investment goals. Therefore, in this video, we are going to discuss with you numerous poor decisions about investments that you must avoid at all costs. A common mistake is to confuse trading with investing. Imagine that you are required to discover exciting new companies in which to invest every day or every week, and that if you go a whole month without purchasing any shares of any firm, you are no longer considered an investor. There are two types of participants active in the realm of the stock market: investors and traders. Someone who buys a stock with the purpose of selling it on the same day or within the following few days is known as a trader. The objective of trading is not to invest in the stock, but rather to purchase the stock quickly in order to benefit from the volatility of the market. Have you ever seen how quickly the price of a stock may change? They never go a single minute or even a single second without jumping up and down, it seems. If, for example, the price begins at 100 and closes at 105, then you may anticipate making a profit of $5,000 for the day if you trade with $100,000 in the price ranges between those two numbers. In concept, this seems to be a straightforward method for generating income, but in fact, it is somewhat more challenging. As a trader, it doesn't matter what stocks you are purchasing, even if these firms are pure garbage, since you're not aiming to retain your money there. Which is what distinguishes trading from investing. Stock values are nearly hard to anticipate in the short term. When you invest, you are purchasing ownership stakes in companies with the expectation that they will continue to generate something of value and, as a result, increase in value over time. Consequently, if there is a single firm that you are aware of that is thriving and you have a good idea of where it will be in 5 or 10 years from now, you could consider continuing to invest in that company. Another common first mistake is ignoring the interest rate on your mortgage or other long-term loans. For the vast majority of individuals, purchasing a home will be the largest achievement and investment they make, and homes are not inexpensive. It takes a lifetime to buy a home these days, and many individuals must take out other loan types since they can't afford to put down the standard 20%, which is why we have mortgages that are 30 years long. However, mortgage rates are something that sometimes people forget to really consider how they affect the cost that you are paying overall. When you can't put down 20%, you'll likely have to pay private mortgage insurance, which increases the cost of your monthly payments. Paying private mortgage insurance or an increased mortgage rate might be worth it if you time the market right, but in today's market, the market is very much in favor of buyers who can afford a higher down payment or monthly mortgage payment. This is why it might not be worth it at all to buy a house if you're not able to put down a significant amount of money to lower your monthly payment depending on the state of the market. When thinking about mortgage rates, let's see how much 1 percentage point changes the broader picture. Imagine you want to buy a $600,000 property with a 3% mortgage rate instead of 4%. Now that's a lot of money, yes, and saving 1 whole percent might actually save you a fortune, even though it doesn't sound like a lot. However, the opportunity cost of that money overall skyrockets when you start to calculate the revenues you could earn if you invest that money that you are saving with that lowered 1%. Think about it this way. Say your monthly payment goes down by about $268 per month if you secure a 3% interest rate over a 4% interest rate on a mortgage. That equates to about $3,200 saved on your mortgage per year. If you invest $3,200 in the S&P 500 index fund annually for 30 years, you'd potentially have $600,000 based on average returns over the last 30 years. You'll see if you're not trying to actively lower the percentage on your mortgage, a lot of money will go to waste ultimately over time. I know I would rather have a home that I own in 30 years after paying off my mortgage, worth more than what I bought it for 30 years prior, as well as having an additional $600,000 in investments potentially. That should give you a sense of how serious it is to consider your mortgage rate and how the savings, along with the power of compound interest, can really add up over time. Investing emotionally is another very, very common mistake. When the value of a certain item shoots up rapidly, a lot of people who previously didn't care about it do all of a sudden because of the opportunity it presents and the fear of missing out. Do you remember what took place with Bitcoin not so long ago? People who had no idea what cryptocurrencies were, say back in 2017, and who had no idea about how blockchain works or the technology behind it, suddenly started buying Bitcoins left and right in the hope that they could make a fortune, and the price rose so dramatically that it caused people who had no idea what Bitcoin was to even start selling off their safer assets like their homes so they could purchase as much Bitcoin as possible. Putting your money into anything based on how you feel is a terrible, terrible decision, and it almost always ends up being very costly and even potentially dangerous. This is in no way discounting blockchain or cryptocurrency or Bitcoin or any other cryptocurrencies. They are an investment choice of many people. This is just one example of how emotional investing has caused a lot of people strife and loss due to trying to time an extremely volatile market, which is really difficult, if not impossible, to predict. Any financial decision you make ought to be based on risk that has been rationally and logically assessed. You will not run the danger of losing all of your capital and will be able to construct a sustainable portfolio over time with this methodology. However, there is a possibility that you may wind up passing up some fantastic possibilities and opportunities, like if you invested in Bitcoin early on. The greatest investor in the history of the world, Warren Buffett, passed up the chance to make investments in Google and Amazon and many other great successful companies. That being said, he is still one of the most successful investors in the world. It's important to not wallow in self-doubt or sadness if you did lose out on an opportunity. This will help you continue with your investments over time and have a rational mindset. There are two categories of stocks that are worthwhile investments. First, the shares of a company that have a bright future and whose current stock price fairly reflects the value of the company right now, rather than the value it will have in 5 or 10 years. And second, shares of a company that are currently undervalued for one reason or another. Anything else is potentially a waste of your hard-earned money. Investing in any other type of investment or item is going to be considered higher risk or extremely volatile, and it is going to be much more risky to invest in those types of items than the previous two mentioned. Another common mistake is waiting too long to begin investing. Timing is truly everything when it comes to investing. The sooner you start, the higher your potential returns will be. You are losing investment money the second you don't put it to work because of the power of time and compounding interest. This is something that you will never get back if you don't utilize it in this moment. We are aware that you may be thinking something along the lines of, let me wait till I figure everything out when I'm ready. But we want to assure you that this moment will never come. There is always going to be something that you are unaware of or need to learn. In order to get started, you don't need to be a financial whiz. If you are not particularly interested in the stock market, it is recommended that you invest with an index fund, begin with a small portion of your savings or monthly paycheck, and then give yourself some time to learn. This will take out what feels like guesswork, and you'll be investing in a low-risk portfolio. After you have educated yourself, you'll be able to invest in companies that you believe will perform better than the S&P 500 in general. You may not have the time, but it isn't necessary for you to spend every day researching market news for hours on end. Find a few YouTube channels that you can learn from and watch a little bit every month. And if you locate an investment that is working well for you, you should stick with it and continue making investments there. Also, holding an investment for longer than 1 year will also lower the tax you pay on any gains you make. So that's another reason why it's important to invest now and not make any emotionally charged decisions, because your older self will ultimately thank you. Ignoring other investment opportunities besides the stock market and not investing in yourself comes in next. The stock market and adding properties to your portfolio may seem like the most promising places to put your money, but that doesn't mean that they're the best. The most profitable investments a person could ever make could be in companies that they had first founded themselves. Investing in the stock market is more about maintaining the growth of your money by counteracting inflation while you focus on expanding your own enterprises. Because if you put your money in a savings account, inflation will ultimately eat them up. Therefore, you should invest in stable organizations that have some opportunity for development. The maximum that you can expect from index funds is around 7 or 8 or at best 10%. Of course, this varies from year to year due to the fact that there have been times when the S&P 500 was higher by 20 or more, but there have also been times where it was lower by a negative percentage. You are capable of and have the potential to have a positive effect on it by investing in your own enterprises. Do not let the stock market cause you to lose sight of reality, since you have no control over these multi-billion-dollar firms and can do nothing about them ultimately. It's possible that the ideal investment opportunity for you personally is by investing in yourself and your potential empire that you are capable of building. Investing in things that are beyond your financial means is the next mistake that we'll cover. Getting energized about investing doesn't take any effort at all. It activates the reward center in the brain, and the opportunity feels good to think about. You look at all of those numbers and want to rush in and win it so that your bank account will be overflowing, right? Everyone who cares about investing dreams of this. However, before you invest any money, you need to take into consideration a variety of additional aspects. If you anticipate needing that money within the next several months or so to pay for your essential needs and costs, then investing it would not be a wise choice for you at this time. Here's why. Because the market is unpredictable, even if it's a huge and stable company, in the long run, it will probably grow, but in the short run, the stock price might fall. And if you suddenly need that money to cover your basic expenses, you might end up selling your investment at a loss. In the long run, however, it probably will grow. And don't forget, taking the money out of the market before a year will mean you'll pay higher taxes on any gains you make. So even if the stock does grow, you might pay in taxes, and it won't really be worth it if you're struggling to get by because you invested unwisely at the time. Naturally, you want to get started as soon as possible, but you also need to be reasonable about how much money you want to put in. It's preferable to begin with something simple but constant, even if it means investing $100 each month at first. Please do take into consideration these common investing blunders. Whether you're new to investing or if you're interested in getting started, these will be great tips to set you up for success. It is excruciatingly terrible to lose the money that you have worked so diligently to obtain through hard work in most cases, in what seems like the blink of an eye. However, reducing losses and errors is essential to success in any endeavor, including the stock market and investing, and we are not claiming that you will never lose anything, since that is a basic element of the game. However, success in any endeavor requires that you minimize losses and mistakes. The last and most important mistake of all is not having a risk management strategy. If you do anything out of this list, follow a risk management strategy, whether you're an investor or a trader, so that you never have to face risking what you can't afford to lose. Check out our channel for more useful tips and information like this in our future videos. Thank you so much for supporting this channel. Subscribe and watch our other videos to learn more about the economy, stock market, and building wealth.